Interpretation of financial statements, that is our next agenda. What we would be covering in this lecture, for a limited company, how we assess profitability of the business, profitability ratios, liquidity and efficiency ratios, financial gearing ratios, and the investment ratios. Clearly, profitability ratios, they measure how business was conducted, how profitable the operations have been through trading and operations, how comfortable a business can pay its current obligations as they come due, how efficient we were in using our assets to generate sales, how efficient we were in collecting receivables from customers. Financial gearing is a measure of risk, means it's a composition of your capital structure. It compares your debt compared to the total investment in the business. And then the stock market ratio, also called the investment ratio. So let us discuss these as we go along. And why do we need to measure such ratios? What actually is the objective? So first and foremost, we calculate these financial ratios to assess the health of the company, how well the business is, how well has it performed. It will also help us identify certain strengths which we can capitalize on and weaknesses which we may have to rectify and do something about. Then not only this, we will also compare our performances for profitability, liquidity, gearing, solvency, etc. We will compare our performance with the competitors and also with the industry averages. And it will also assist the company management in making the decisions. And also it will assist the stakeholders to assess the stability of their interest in the business. For example, it will provide information to shareholders regarding profitability. It will provide information to bankers regarding solvency and payments on time. It will also provide information to suppliers to decide should they continue supplying us goods and services and credit. And it will also provide information to employees that should they continue working or should they look elsewhere for the job. These ratios that we're going to calculate, they do not speak for themselves. They don't tell for themselves whether they are good or bad. So we need to compare these ratios with some standards, with some benchmarks. So what are typical benchmarks? We may compare our results with our past periods to see how well we have done compared to the previous periods, 2 years, 3 years. We can compare our ratios during the period with similar businesses. That's comparison with competitors' ratios, so that we can see whether we are better off or worse off. And then we may set our own targets and we compare our performance with the expected results. And there could be other multiple benchmarks. So you can't make any sense out of ratios unless you have some comparator, unless you have some benchmark against which you will gauge your performance. We have classified our ratios into 4 categories. Profitability, to assess how well we have conducted our operations, how profitability we have done them. Liquidity and efficiency, these ratios will measure our ability to pay its current obligation as they become due. Efficiency ratio will measure how effectively we have managed our assets to generate sales, how efficient we were in managing our working capital, how good we were in collecting our receivables, how good we were in paying to our accounts payable. We'll discuss them in detail. And then we will discuss financial gearing. Within this ratio, we'll also assess how easy will it be for the business to pay its long-term obligation when they become due, called solvency. And finally, we'll discuss some investment ratios to be used by the shareholders to assess how well the business is doing with regard to the stock market. So within profitability, we are going to discuss these 4 ratios. Then in liquidity, we will discuss current asset test, inventory turnover, debtor collection, and the creditor payment periods. Then in financial gearing, we'll discuss these 2. And then in investment, we'll discuss these 5 ratios. Among profitability ratios, we have first, return on ordinary shareholder funds. What this ratio measures for us? This ratio represents profit expressed as a percentage of the funds provided by the owners, by the shareholders. So in other words, it's a percentage of profit upon average shareholders' equity. Let me show you how. Here we go. We have got stockholders' equity opening plus closing divided by 2. This is the average equity. And equity includes your common stock, preferred stock, additional paid-in capital, which is an equivalent term for share premium, and retained earning. So total stockholders' equity or shareholders' equity opening plus closing over 2. 725 is the average equity. So we take this as a denominator. Assuming profit is 150,000 for the period, upon average equity it's 20.68. Now the question that it should be asking me, why do we need to average the equity number opening plus closing upon 2? The problem is that if we take just the closing figure of equity and we are taking profit for the whole period, so we are comparing a periodic number with just a static number at the balance sheet date. So it's recommended to take the average figure of equity. So whenever you are connecting two numbers, one from the income statement, other from balance sheet, it is advised that balance sheet figure must be averaged. So we get 20.68. This percentage itself doesn't give any meaning unless you compare it with the last year. How did you do last year? You compare it with your competitor, or you may compare it with the industry average. So then it will make more sense. So return on capital employed, return on ordinary shareholders, return on common equity. There are many alternative terms used, and this is one of the most frequently used profitability ratio. Going a step further, return on shareholder equity was calculated. Now we need return on the capital employed. So this ratio demonstrates how good a company is turning capital into profit. So when we use the word capital employed, it goes beyond shareholders' funds, beyond the shareholders' equity. It also involves long-term debt, right? So this time we are not just going to use equity, we are going to add long-term debt and equity to find the return on capital employed. And remember, previously we took net profit, but for return on capital employed, we take operating profit, that is profit before interest and tax, because we have to incorporate long-term debt that has interest component. So we need to find out the profit expressed as a percentage of capital employed, and for that you need the profit before interest and tax. Here it is. Capital employed is equal to total equity plus long-term debt. So combining these two gives you the formula operating profit upon average capital employed. Let me show you how do we calculate this. So this is our stockholder equity plus non-current liabilities called long-term debt closing, plus stockholder equity and long-term debt or non-current liabilities opening. So opening equity and long-term debt plus closing equity upon plus debt upon 2 gives you the average capital employed. So now let us calculate return on capital employed this time. It's equal to operating profit upon average capital employed, which is 1.3675 million. And let's say if our net profit was 150 in the previous example, then operating profit, that is profit before interest and tax, has to be higher, and assuming it's $250,000. So 250 upon the average capital employed gives you 18.28%. So again, this percentage won't mean anything unless you compare it with last year, with competitor, or your expectation, or the industry average. So again, we took operating profit for the year and we took average of the capital employed, because whenever you take the income statement number and a balance sheet number must ideally be averaged. Next we have gross profit margin. Gross profit margin measures your trading profit, that is profit in buying and selling goods. It doesn't include any operating expenses. So they relate to your trading business. They do not include operating expenses. Let me show you how it is calculated. You take net sales, sales minus returns or any allowances, less cost of goods sold, gives you gross profit. So gross profit expressed as a percentage of net sales, sometimes also called gross margin. So it's a very important number, because this is your trading profit. If you have a sizable trading profit, then it will have impact upon your operating profit as well as your net profit. So this figure can have significant effect on your bottom line, means your net income after all the expenses have been paid up. So again, this percentage won't make any sense unless you compare it with the last year, with the industry average, with competitor, or your expectation. Gross profit expressed as a percentage of net revenue. Next, then operating profit margin. We take gross profit as a starting point. We deduct our operating expenses. Deducting operating expenses gives us operating profits. Operating profit is what percentage of our sales. This is called operating profit margin. So it shows you what percentage remains of profit after selling and general and administrative expenses have been paid. Means operating expenses deducted from gross profit gives you operating income, and it is what percentage of net sales. Again, this percentage won't make any sense unless you compare it with your last year operating profit margin, or your industry average, or your competitor, or your expectation. Next set of ratios, liquidity and efficiency. Let's discuss what is liquidity. Liquidity is a firm's ability to pay its current obligations, its current liabilities as they come due, and thus remain in business in the short run. Meaning you are capable to pay your current obligations within the current period and still remain in business. And for this, your current assets should be more than your current liabilities. Only then you will be able to not only settle your current obligations, you are still left with some resources to use in business operations. Current ratio is the most common measure of liquidity, and we use current asset as a numerator and current liability as a denominator. And let's apply this in an actual condition. Current year, our current assets are 760. That includes your cash, inventories, account receivables, prepayments, all current assets. And our current liabilities were 390. So 760 upon 390 gives us 1.949. What does it mean? It means for every $1 liability, we have $1.949 worth of current assets. So it's showing quite a safe margin. What was the case last year? Last year, our current assets were 635 and our current liabilities were 275. And last year, for every $1 liability, we had $2.309 worth of current assets. That means our liquidity, means our ability to settle our long-term, short-term obligations, it has deteriorated in reality. So even the number looks good, but it has decreased over the period. So current assets expressed as a fraction of current liabilities measures how comfortably a business can pay its current obligation. But the problem with this ratio is that there are certain current assets like prepayments, like inventories, they are not easily convertible to cash. So despite calculating this ratio, this is not a good measure of liquidity. It still has certain assets which are not readily convertible. You can see a very low ratio, 1 or less than 1, implies that the company would have difficulty in paying the obligation, and a ratio over 3, I would say it's too much. 2 is fine, 2, 1. Suggests that the company is not using its current assets sufficiently. That's an over-investment in current assets. So ideally, should be around 2, 1. For every $1 liability, you have $2 worth of current assets. And that's how we calculate. The problem with this ratio is that it includes inventories and prepayments which are not readily convertible. So we come up with a more conservative measure called the acid test ratio, sometimes called the quick ratio. It is similar to current ratio, but it excludes inventory as well as prepayments. Prepayments means you have made payment of insurance in advance or rent in advance. So these prepayments are not likely to be converted in cash, so they are removed from current assets. So this ratio is more stringent, more conservative measure of liquidity. Let's apply this. So this is how we calculate. We just take the quick assets, cash, marketable securities, and net receivables. We do not take inventories or prepayments. So you can just see what we're doing here. Current year, our current assets excluding inventory and prepayment is this much. And this is what fraction of 390? 1.705. That means for every $1 liability, we have $1.7 worth of quick assets. Good. What was the case last year? The case last year was that we had these many quick assets starting from 275 through 40 and dividing it with the last year current liability. It was 2.09. Good. So previously for every $1 liability, we had 2.09 worth of liquid assets. So previously our liquidity was better last year, and it has deteriorated to some extent now. So let's say you calculate your current ratio as 3:1. But when you calculate your quick ratio, it comes out to be just 1.2:1. That tells you a lot. If the asset trust ratio is much lower than the current ratio, it indicates that current assets are highly dependent on inventory or prepayments. Right? What is the ideal standard for quick ratio depends upon the industry, so it's highly industry dependent. It varies from industry to industry, but ideally it should be at least 1:1. Below 1 could be a problem. Current assets less inventory, and you must deduct prepayments also and express this as a fraction of current liabilities. Next we have inventory turnover. It is one of the efficiency ratios, how well we are managing our current assets and long-term assets. Inventory turnover, it measures how quickly we are able to sell our inventory during the period or during the year. How many times your inventory turns, or ideally we would like to measure it in days, that after how many days on average we are able to sell our inventory. So inventory turnover is calculated using this formula, average inventory upon cost of sales times 365 or 360 or whatever the number of years might be given in the question. So a slow turnover means that the business funds are unnecessarily tied up in inventory, and it may result in many losses related to inventory storage, insurance, pilferage, deterioration, inventory getting outdated, so on and so forth. So it calculates after how many days does your inventory turn or sold to customers. The lower the better. You frequently sell your inventory and it converts to cost of sales against your sales and generates profit. Let's take some imaginary numbers. Our average inventory was 10 plus 20. Opening 10, closing 20 upon 2. Average 15. So our average inventory is 15,000. Our cost of sale, let's say just for sake of understanding, $50,000 times 365. So if you simplify, what would it mean? 15,000 times 50 times 365 gives you 109.5. It means after approximately 109 days, our inventory is turned into cost of sales, or it is just sold. So last year, if it was 150, then it means this time we have been more efficient in managing our inventory. So the lower, the better. Your inventory turnover days must be as short as possible. You don't need to invest too much in your inventory because unsold inventory involves cost. Next, debtors collection period means how long an average business takes to collect money owed by its trade debtors. Right? Like for example, we have allowed 60 days trade credit. Our customers should pay the invoice within 60 days. If they are taking longer, if our average collection period is longer than 60, it means our collection procedure isn't good. Our credit collection department is not doing well. So it has to be around 60. Right? If your result is nearly 90, that means it's the collection process is inefficient. Extended credit terms may distort comparison. If you give 100 days to your customer for payment, whereas the industry average is 60. So such extended credit terms, 100 days versus industry average 60, this may distort comparison. So ideally, if two businesses are similar in nature and they tend to have same credit terms, so their average collection days must be similar. And how can you shorten your collection period? Give them settlement discounts. Generous cash discounts, remember, these are called settlement discounts. So encourage your customers to pay you promptly. And this would result in more cash being collected, so average collection period will fall. How do you calculate this? This is how it's calculated. Average trade receivables upon credit sales times 365. Again, credit sale is an income statement item, trade received from balance sheet, and balance sheet item must be averaged. So let's take some imaginary numbers. Let's say your average trade receivables is $45,000 and your credit sales, let's say it's about $200,000. You don't take the full sales. That includes cash sales, just credit sales. But if it isn't available in the question, you are given just a single figure for sales, only then you have to take that number. Ideally, you need to take credit sales because credit sales generates account receivables. So 45,000 upon 200,000 times 365 should give you the average collection period. It's 82 days. It means on average, we collect money from our customers on average in 82 days. Now, if our credit period or the credit term is 60 days, that means we are not managing our receivables efficiently. However, if your credit term is 90 days, that's the credit period, then yes, you are within the limit, so it's good. So next we have creditor's payment period. That is the average payment period. Means just like how many days do you take to collect money from your average account receivable, it's like how many days do you take to pay your average account payable. So the idea is similar but in the opposite direction. It shows you the average time, number of days a business takes to settle its debt with its trade supplier, right? And this is how we calculate average trades payable upon credit purchases into 365. Same thing. Trade payables come from balance sheet, must be averaged upon credit purchases ideally, but sometimes if credit purchases are not available, nothing can be done, no way to find credit purchase, then you need to take the purchases figure. So the question need to follow the specific requirements of the question. So it shows how well business is taking advantage of available trade credit. If you take longer to pay, it's good for your liquidity. So a golden principle that we keep on using in business environment, in financial management: collect your receivables as early as possible within the credit period and pay your suppliers as late as possible without damaging your relationship with your vendors. This would help you maintain your liquidity at a suitable level. Let's say our trade payables on average are $27,000. Our credit purchases are $75,000 times 365. So 27 upon 75 times 365, that means we pay our suppliers on average in 131 days. Good or bad you can't say unless you can compare it with your industry average or you compare it with your credit terms with the suppliers. Next set of ratios we have are gearing ratios. There are many, but we're going to discuss just one. So gearing measures what? See, we deploy different sources of long-term finance: common equity, bonds, bank loans long-term, debentures. So gearing basically measures how much long-term lenders contribute to the overall capital of the business. Like for example, if I have total $100 million worth of long-term funds deployed in my business, of which 90% or 90 million belongs to the stockholders, that means this $10 million of long-term funds have come from lenders. So if you calculate the gearing, it is 10 by 100, clearly 10%. 90% is equity and 10% are long-term debts. So gearing is 10%. How is it calculated? It is calculated by taking long-term debt and expressing it as a percentage of the total long-term capital, equity plus long-term debt. And anything below 50% is good. Above 50% means you have more debt in your business than equity. Let me show you how do we calculate this. Long-term debt. Okay, here we go. Last year our non-current liability was 675 and the equity was 650. So 675 is what percentage of the total capital? Non-current liabilities plus stockholders, it was 50.9%. In the current year, it's 610 over 610 plus 800, that's 43.3%. So that means our gearing has decreased from 50.9% last year to 43.3%. And we just discussed that level below 50% are considered to be acceptable. Anything higher than 50% means we are relying too much on the long-term debt, which could be risky. Next ratio we have is interest cover. It determines how easily a company can pay interest on debt as it becomes due out of the available profit. So let me tell you an idea to understand. Let's say our operating profit before tax and interest is $100,000 and our interest charges are $5,000. If you divide, which means it's 20 times. You know what it means? It means I have generated such a significant amount of operating profit that I can pay my interest charges 20 times out of that profit. We have to pay once only, only once. But this is showing us that we have a high level of cover. So this gives confidence both to lenders and shareholders that the profit is so sizable that interest can be paid 20 times out of it. Even we have to pay only once. So higher the better. More confidence lenders and shareholders will have. And a low level of interest coverage is a warning sign. Let's say if our profits are 7,000 and our interest charge is at 10,000, that clearly means that our profits are only enough to pay 0.7 or 70% of the interest charge. That is a warning sign that we do not have sufficient profits to cover the interest payments. Next, we have dividend payout. Dividend payout shows you how much of the profit earned during the period is being given to the ordinary shareholders. It indicates the percentage of profit paid out to ordinary shareholders as dividends. Let's say company generated $100 profit. Out of this, $20 is being given dividend to the shareholders. This is called dividend payout. 20 by 100 is dividend payout. And if you ask what is the retention ratio, $80 has been retained out of 100. So $20 or 20% is the dividend payout, 80% is the retention ratio. So the profit that remains undistributed, it becomes part of your retained earning as a source of finance which we will use in future investments. So here we go. This is the formula we use to calculate the dividend payout. Dividend announced for the year, including any interim dividend declared and paid during the period. Let's say in our example it was $20 total, and profit for the year is 100, let's say, for simplicity. So dividend payout is 20%. Why the company retains so much of the profit in the form of retained earning? Because retained earning is a source of finance for the business, which is easily available. Business don't have to rush to the bank or issue bonds or bank loans. This retained profit can be used as a source of finance for future business expansion. Next. Okay, now let's say I have received $5 dividend in total for the whole year. And the share price, assuming the share price didn't change in all the year, the share price is $300. I got just $5 on a share which has a market price of $300. So if I calculate what is the return as a percentage of the market price, this is very less, of course, which is just about 1.67%. Well, fine, but what if the share price appreciates? That is again your benefit, of course. Share price appreciates, you will benefit. But for now, if I just compare what I get, just $5. And what is the market price of the share is $300. So I'm just getting $5, which is 1.67% of the market value of the investment. So this ratio is used by the shareholders to assess the cash return of the investment. So you get $5 out of $300 market price. That's it. Dividend per share, 5. Market price per share, 300, and it is expressed in percentages, 1.67%. Next, we have earning per share. This is a very important ratio. Probably only ratio which has been covered by an accounting standard, IAS 33, earning per share. But you're going to study the basic version of EPS. Otherwise, the standard that we follow to calculate EPS is quite complex. So what it calculates? It calculates, let's say if a company earns $150,000 over the year. This is the company's earning. If this earning is distributed on the shares outstanding, let's say there are 500,000 shares outstanding. So this gives you the earning on per share basis. If you calculate this figure, it's $0.3 per share, or you may say it's 30 cents per share, right? So earning expressed as on per share basis, this is called earning per share. It's a very important ratio. I told you it is the only ratio which is standardized and needs to be calculated as per the accounting standard IAS 33. So this ratio shows you what? It shows you how much profit for the company is making on per share basis. This is not the same as dividend per share. This is the earning over number of shares. That's how you calculate profit for the year divided by the number of shares issued. This ratio is very useful for the shareholder to reveal the trend or the comparison with the other businesses. We can compare our EPS with those of other businesses in the similar industry, same industry. So that shows you how well your business is performing compared to others. We can also compare EPS for the prior years with the current year. So this is regarded by us financial analysts as a fundamental measure of firm performance. The ratio that you see here is extremely simplified version. The proper way we calculate EPS is way more complex, in which we take the income available to common stockholders, and in the denominator we have weighted average number of shares. That's the complex version, but that's what you need to know for now. Profit for the year divided by the number of shares outstanding or shares issued. Next ratio we have is price earning ratio, also called price earning multiple. It's equal to market price per share over earning per share. Right? Let's say market price per share as we speak is 500 and EPS is 50. So what you get is 10. You know what it means? It means in order to get $1 earning in this company, an investor is ready to invest $10, or to get $50 earning, an investor is willing to pay $500. Why an investor would do that? Because the investor is confident that the firm will do well. High price earning multiple like this 10 shows company has growth prospects. So the company may perform well in the future. So high price earning ratio means a good thing for the investor. So this is how you calculate market price per share over earning per share. It compares the current market price shares with per share earnings, growth prospects. It shows the investor's confidence in the firm, and it also shows prospects to take over. If the company that has higher PE, it is seen as a growth potential, and many investors are willing to take over such a business. Next we have an example. OGDC, Oil and Gas Development Company. It is the largest, most capitalized listed company in Pakistan Stock Exchange. So these are the figures: earning per share, dividend per share, book value per share. Price earning multiple 10.75. Stock market was suspended during this time, September 2008 to December 2008. It was suspended. Why? Due to significant drop in market, authorities in Pakistan halted trading to prevent further rot, to prevent further decline. And that was the time when I decided that stock market is not my cup of tea. And that's the time when I moved out. So at that time, during freeze, this was the price earning multiple of OGDCL, indicating that future looks bleak, dark. But before the freeze, it was 10.22. So you can imagine that price earning multiple shows you the prospects, how the company performs and will perform. Next ratio we have is book value per share. What it measures, let's say if I take all my equity, which includes your common stock, your additional paid in capital called share premium, plus retained earning, plus your other capital and revenue reserve, dividend equalization reserve, debenture redemption reserve, all the reserves created out of equity. Total equity attributable to common stockholders. And you divide it with the number of shares. What it gives me? Let's say my common equity is $1.5 million. And the number of shares outstanding is 500,000. So if the equity is distributed among shareholders, what you get is $3 per share. So this shows you that if the equity is distributed to ordinary shareholders, what each shareholder would receive means how many resources the firm have to repay shareholders in the event of financial difficulty. So this is how we measure we take shareholder equity and we divide it into the number of ordinary shares. Quickly see what it shows. It shows per share value of the company is based on equity available to shareholders, equity divided by the number of shares. It's a good starting point to investigate the health of the company. How? It shows how many sufficient resources the firm has to repay shareholders in the event of financial difficulty. So now there are certain limitations to ratio analysis. We do use ratio analysis for evaluation of the company's performance, comparing its performance with those of the others, then making some forecasts for the future, but there are certain limitations. First, it depends upon the quality of financial statement. If the financial statements are forged, fraudulent numbers are added, this is called window dressing, then any ratio analysis that you draw based on those false numbers will be useless. Next, if inflation is ignored, comparisons may be distorted. Yes, inflation, I'm sure you know, is persistent increase in general price level. So if the price level has been increasing over the last few years, then the comparison between last year numbers and this year numbers will be seriously distorted because of the effect of inflation. It gives a restricted view of business performance. Yes, just few areas. We just saw liquidity ratio, efficiency, gearing, interest coverage, but there are many other areas. It doesn't assess the company's operational capabilities. Then the another restriction, the basis of accounting must be same when comparing with different companies. Yes, if you are comparing company A, B, C, D, they must have the same accounting standard. They must have same accounting basis so that comparison is meaningful. Then statement of financial position ratios only show situation at a date of time. But that's absolutely right. Let's say if you've drawn up your financial statement and your balance sheet is reported 31st December 2024, it means it's and on this particular point in time, a day before that, a week after that, things can totally change. Maybe if you're using financial statements for the year ended 31st of December 2024 and you are analyzing the numbers on maybe 6th of June 2025, the numbers are nearly 5 months old, may not be relevant. And then finally, ratios are an aid to good management. They help you in decision making, but they are not substitute of management themselves. That ends your topic, ratio analysis.